Sam opens his phone. His favorite artificial intelligence stock has doubled, and every headline says a new economic era has arrived. Then, someone predicts a 60% crash. That sounds impossible if the technology is real, useful, and still improving every month. But a great invention and a terrible investment can exist together. The difference is the price paid for uncertain future profits. Consider Atlas AI, a fictional company earning $1 per share today. Investors bid each share up to $100. Its price-to-earnings ratio is 100. That means buyers pay $100 for each dollar of current annual profit it earns. They are not buying today's business alone. They are betting Atlas will grow fast enough to justify that unusually demanding price. As the stock rises, more people buy because it rose. Optimism becomes evidence, and yesterday's price attracts tomorrow's money from outsiders. Founders may sell existing shares, creating more sell orders. Companies may issue new shares, increasing supply and diluting existing owners over time. This matters now. In November 2025, the Federal Reserve described asset valuations as elevated across a wide range of financial markets. It also reported hedge fund leverage at its highest level since data began in 2013. Borrowed money makes markets more fragile. Sam puts in $5,000 and borrows another $5,000. He now controls 100 Atlas shares at $100. If Atlas rises 10%, Sam's own money gains 20% before interest. Borrowing has doubled both his exposure and excitement. A crash does not require the technology to fail. It only requires expectations to fall faster than the business can improve. The trigger could be slower sales, higher interest rates, heavy competition, or simply fewer buyers willing to pay an extreme valuation. Suppose Atlas performs well and doubles its profit to $2 per share. The technology works and the company genuinely improves. But investors now pay only 20 times earnings. $2 multiplied by 20 gives a share price of $40 even today. Atlas became twice as profitable, yet its stock fell 60%. The collapse came from the valuation, not the invention itself. Sam's shares are now worth $4,000, but he still owes $5,000. His entire investment is gone, with debt remaining. His broker can demand more cash or sell the shares. That forced sale happens because of the loan, not Sam's opinion. When many leveraged investors face the same problem, forced selling pushes prices lower, causing new margin calls and still more selling. Falling prices also shrink collateral, the assets backing loans. Lenders respond by demanding safer terms, exactly when borrowers most need flexibility. Financing becomes expensive. Atlas cuts projects and hiring, even though its software still works. A market correction reaches the real economy. I can also replace some tasks over time. During a bust, that gradual disruption collides with layoffs caused by tighter financing. Now, remove the loan. Sam's unleveraged $10,000 still falls to $4,000, but nobody can force him to sell at the bottom. Better still, If Atlas is only one part of a diversified portfolio, one collapse cannot erase everything he has built over many years. Cash for near-term needs matters too. Inflation erodes purchasing power, but an emergency reserve prevents desperate selling during a downturn at the worst moment. This is why preparing does not mean guessing the top. Even sophisticated investors struggle to time bubbles consistently in advance. Preparation means limiting leverage, diversifying across assets, and keeping enough liquid savings for the years when income or markets disappoint badly. The real warning is not that AI is fake. It is that a real revolution can still be purchased at an unreal price. Technology changes what companies can earn. Valuation decides what investors receive.